Good day everyone and welcome back. Today's video will be a market review for the 24th of July, Monday. We'll be having a look at the Euro USD pair. In this review, I'll be discussing and I'll present you my notes on the balanced price range, and I'll show you how we used some of the logic suggested by this PD array and how you can use it in confluence with some of your other analysis to support high probability trade opportunities. And I'll give you an example of how I used it to trade the London session for Monday. A balanced price range represents an area of trading that, due to the way in which the market delivered price, should not facilitate transactions reapproaching the highest price of the range. A balanced price range is said to have two functions in following this logic. The first allows for the market to reprice no more than 50% or equilibrium of the range established by a balanced price range. As long as candles continue to close below or above equilibrium, the balanced price range is effective at resisting price. The second function of a balanced price range is to resist further repricing inside its range. So rather than return to equilibrium, the market displaces quickly away from the consolidation to target real liquidity below or above market. When we make reference to a balanced price range, what we are suggesting is that there is a definitive boundary which we don't want to see breached. This boundary refers to the area encompassed by the bodies of two opposing inefficiencies. On the daily chart, we have a balanced price range created in opposing liquidity. The sell side of the wick was delivered on Thursday, leaving Friday to retrace off the weekly range and go into consolidation. This section of price is time distortion. You can refer to ICT's June 15th price action workshop video on YouTube and reference the 4-hour and 22-minute mark for more information on that. Moving down to a 4-hour chart. The 4-hour fair value gap low was an intraday or intra-week target. I have shaded then the 4-hour fair value gap. This will become significant as we move down to the lower time frames. We will see how the shift in market structure and delivery of price were formed as we breached the lower areas of the inefficiency. Initially, at this low, there was a potential for a turtle soup. Obviously, the velocity in which the market repriced through this imbalance nullified any such possibility. This 1-hour fair value gap was extremely pertinent to future price action after the market was seen to trade through it. In this case, we can anticipate an inversion of the fair value gap. It therefore became an intraday target for retracements. And you'll see when I give you an example of the trades that I took, I used this draw, that is the rebalance of this inversion, as a draw on the market, as this would be considered a return to fair value reversal setup. Next, we can note this 1-hour fair value gap. Extended through time, it becomes a target for intraday move after midnight on Monday. When relative equal highs are established during Sunday evening's trading and the trading that took place on Friday's New York PM session, price is seen to expand consistent with a false move after midnight's opening price. This is also consistent with the theory of AMD, when you have a period of accumulation followed by manipulation and the distribution of price lower. Moving on then to a 5-minute chart. Note the initial displacement as price is moved through the 4-hour imbalance. Also note this 5-minute rejection block. This rejection block is important because it supported our analysis at the time that price was likely moving from a sell to a buy model, at least from an intraday perspective. As we'll discuss, these are the types of qualifying factors supporting judgment claims about market structure shifts. Identifying and weighing out these type of confluences gives us evidence to support the best trade opportunities. This will be the type of context that needs to be present when trading balanced price ranges. It's not good enough to trade the existence of two opposing fair value gaps and infer that that is a balanced price range. There is a very limited logic in that assumption. Rather, we need to employ a number of confluences before assuming the logic that makes a balanced price range a tradable PD array. On a 2-minute chart, you will see a down close candle over here, time distortion, and an up close candle. This is a potential balanced price range. Limiting this designation are supporting confluences. So, no opposing premium arrays are engaged and traded through. No short-term high or inverted fair value gap is reclaimed. These would be the type of qualifying factors that, not being present, should temper our expectations that price is ready to move higher, and that this range was unlikely to have the impact on repricing we would otherwise anticipate from a balanced price range. Even though two opposing inefficiencies are formed, no qualifying factors are present, particularly that factor seen when price is able to engage with opposing PD arrays. Therefore, it would have been a risky trade, but it could have reversed at this point. In this case, it did not. Rather, or more saliently, after engaging this rejection block, a higher probability trade, supported by more qualifying factors, forms. Firstly, prices seem to respect the support provided having traded into a rejection block. This can also be considered an order block created in opposing liquidity, which makes it a high probable area of support. This down close candle is met with an up close candle, and a balanced price range is formed. When the opposing swing high and inverted fair value gap are claimed, we assume the appropriate qualifying factors are present to support the function of a balanced price range as it resists the reapproach of price inside its value area. So what are we saying? We are saying that given the fact that price was willing to trade above and through two opposing PD arrays, we can safely assume that the range formed at this location is a balanced price range, and that we do not expect or anticipate price to engage back down to this area. Like we said in the beginning of this video, a balanced price range represents an area of trading that, due to the way in which the market delivered price, should not facilitate transactions reapproaching the highest or lowest price of that range. So what makes this a failed balanced price range and this a successful one? It's the qualifying factors and the context that support the formation of the balanced price range. Without those factors, we cannot trade it with any great degree of prognostication. You'll see as the day's trading progressed, the role that inverted 1 hour fair value gap eventually plays. This was this inversion is the draw on liquidity. And what gives any trade at this location validity is the fact that there is a higher draw on market. In that context, I'll show you 2 of the trades that I took for the London morning session. You'll notice here, this was the first attempt to go long, which I was stopped out. At the time, my analysis was slightly flawed, and I assumed a balanced price range without the relevant confluences. And this is the second trade, taken on the assumption that the price had created a balanced price range and was now gravitating towards higher targets intraday. You'll see I noted here important considerations. The intermediate turn low for our fair value gap had just been repriced to. We retested a 5-minute rejection block. A balanced price range formed, and we saw displacement and speed through opposing PD arrays. In essence, blend inefficiencies to establish balanced price ranges. Use the logic of balanced price ranges in confluence with the information accumulated from other price action formations to gather evidence supporting likely shifts in the price engine model. As a bonus, I'll quickly talk about this trade setup that formed. Posted inside the standard fair value gap is a price engine model consistent with reaccumulation. Compared to price action in the dollar at the same period, lower lows are formed as price moves back into the value area of the standard fair value gap. In the euro, price is seen to distribute, making lower highs in comparison to the lower lows formed in the euro. This is asymmetrical price action and is institutional market structure. As a result, we see price expand to that inverted 1 hour fair value gap on the day. So I think that ends the market review for the 24th of July. We introduced balanced price ranges, we introduced the logic, and I've told you some of the conditions you need to look out for when trying to trade them. If you liked this content, if you found it helpful, be sure to leave me a like and leave me a comment. It does encourage me to put out more of this type of information. Until next time, keep well and God be with you. Cheers.